Alright, let's talk a little bit about notes receivable. Your book does a pretty good job of defining notes receivable and laying out the different terms that you need to be aware of. But basically, when we talk about notes receivable, we're generally talking about a promissory note, which is a written promise to pay a specific amount of money, usually with interest, on a particular date. As it says here, these notes are used in many transactions, including paying for products and services or just when you're borrowing money from somebody. A seller will ask for a note sometimes to replace an accounts receivable if a customer requests more time to pay for a past due account. And there's legal reasons why you might want to do that. So here we have an example of a note, a promissory note. It's dated July 10th. It's often actually titled promissory note right on the form itself. And in this case, you have a woman, Julia Brown, who's promising to pay TechCom a certain amount of money, in this case $1,000, and the $1,000 is the principal. That's the amount that is owed. Brown is the maker of the note. She's the one who is making it out to the payee of the note, who is TechCom. And it tells you when it is due. So in this case, it's 90 days after the date that it's being issued. It gives you the amount of the principal. And it also excuse me, tells you the amount of interest that's being charged, the percentage of interest generally, not the actual dollar amount. So when you're computing the maturity date, which is talked about here, the maturity date of a note is the date the note must be repaid. The period is the amount of time between the date that you contracted it, in this case July 10th, and the date that it's due. So in this particular note, it's 90 days. To figure out the exact date that something is due, you generally just do a chart like this. The days, we have 31 days in July. The date of this note is the 10th, so that gives us 21 days in July. There's 31 days in August, 30 days in September. If you add 8 days from October, you get the 90 days. So in this case, this particular note would be due on October the 8th. To figure out the amount of interest that's going to be owed on this particular transaction, obviously interest is the cost of borrowing money for the borrower. For the lender, it is revenue to the lender. And what we do is we take the principal, in this case it was $1,000, the annual interest rate, 12%. So you're multiplying principal by the interest rate and the amount of time that's involved to get the dollar amount of interest. This explains that often we use 360 days instead of 365 in a year. This is called the banker's rule. And you have to know if you're using a 365-day year or a 360-day year. So whenever you're looking at a problem, make sure that you pay attention to what is actually being used. If we use the banker's rule in this case, we'd have $1,000 times 12%, and it's only 90 days, so it's 90 over 360 because we're using a 360-day year. So we would get 1,000 times 0.12 for the 12% interest, times 0.25, which is 90 divided by 360. So the amount of interest on this for 90 days is going to be $30. This also explains that if you don't use the banker's rule, then you would figure out the amount of time by taking 90 and dividing by 365, because there's 365 days in a year. So in order to recognize your notes receivable on your accounting statements, in this particular case, we have a note receivable for $1,000 and therefore a sale for $1,000. So we're debiting notes receivable. It's an asset that goes on the income statement, on the balance sheet. And then our credit goes to sales for $1,000. So our assets and our liabilities are equal here. Now, sometimes if you've sold something to somebody and they haven't paid you and you're now going to give them longer to pay by accepting a note, you may want to get some of the cash up front and give them a note for a portion of it, and that's the example given here. So if somebody owes you $832, but they tell you, I can't pay it all to you right now, you may take some of it in cash, so your debit would go to cash, in this case $232. Then the amount that you're issuing, or that they're issuing a note for, would be an asset to you, so you would have a $600 note receivable, and you would put a credit to accounts receivable because they already owed you the money, so now you're taking it out of accounts receivable and moving it to notes receivable, but a portion of it is being received in cash. So this would be how you would handle converting an accounts receivable into a notes receivable, especially when you're bringing in some cash from that particular transaction. So you've given somebody the opportunity to have longer to pay for this. In this case, this person has a note that they've issued to you for $600. Now, if they actually pay you like they're supposed to, we said up here that this would be a 15% note. So you'd have to figure out what the 15% is for the 60-day period, and they have calculated that would be $15 in interest. When they pay you, you debit cash for $615 because you're collecting interest and the amount of the note. You credit notes receivable for $600 because that's all they owed you, but you also credit interest revenue for $15 because you've made $15 off of this in interest revenue. If the person does not pay you, the note comes due, they don't end up paying, what we do is then we take the note receivable and move it back into accounts receivable. They still owe you the money, so it's still an accounts receivable, but we're going to take it out of notes because the note itself is expired. So you can't leave it in notes receivable because that particular note has expired. So we're basically converting it, taking it out of notes receivable, putting it back into accounts receivable. But in this case, we also have to put the amount of interest that we should have received there, because if we're going to go after this person in terms of collections, they don't just owe us $800 now, but they owe us $816 because they had promised to pay us 12% for that 60-day period. So this is a dishonored note, meaning the person did not pay as they promised to do so. You also make sure you explain it so that it doesn't look like you just made a sale here. It explains why this is being moved back into accounts receivable. Now, when you get to the end of an accounting period and you have a note that spans that period, it goes from the current period that you're in and then into the next period, then we have to make an entry for the amount of interest that has been earned in that period. So when we have notes receivable outstanding at the end of a period, any accrued interest earned has to be computed and then recorded. So on December 16th, TechCom accepted a $3,000 60-day 12% note from a customer and granting an extension on a past due account. So when we get to December 31st, some of that interest that has been promised to be paid has already been earned in that particular accounting period. We calculate that by saying it's a $3,000 note, 12% for 15 days, because it's the 15 days between December 16th and December 31st, and the amount of interest for that period is $15. So we put 15 in an interest receivable account because we haven't received the money yet, but it's an asset to us because we should be receiving it, and then we've earned it, so we put a credit to interest revenue for $15. Now, if this person pays us as they're supposed to on February 14th, we're going to get a total of $3,060. So we would put that into cash, another credit to interest revenue for $45 for the rest of the interest that has now been earned, a credit of $15 to reduce the interest receivable because now we've received the money, so we no longer have this, so we have to reduce it, and then a credit to notes receivable to clear out the note because they've paid us, so we no longer have that receivable. So those are the types of entries that we would have to do in that situation. All right, the last thing in this particular chapter talks about disposal of receivables. And you may or may not encounter this depending on what type of accounting you do and what kind of company that you're dealing with, but this is common in some industries. If you need money, you can convert your receivables to cash before they are actually due. So you do this either by actually selling the receivables or using them as security for a loan. Recent survey shows about 20% of companies obtain cash this way. So when you sell receivables, you can sell all or a portion of your receivables to a finance company or a bank. The buyer is called a factor, meaning the bank or the finance company is the factor, and you're the seller. You're selling your accounts receivable. And they're going to charge you a factoring fee for taking on your accounts receivable, because they're actually taking ownership of that, and by doing that they're taking on the risk that some of those accounts receivable may not be paid. So if TechCom sells $20,000 of its accounts receivable and is charged a 4% factoring fee, this is how they would record it. They receive cash of $19,200. They have a factoring fee expense of 4% times 20,000, which is 800. So you have to debit the expense account, and then they're getting rid of $20,000 of accounts receivable. So they no longer have this asset. So they have to credit accounts receivable. Now, that's actually selling your receivables, but there's also the way that you can do this where you're pledging your receivables as security for a loan. And in that case, you're not transferring those to them. So you're not actually getting rid of your accounts receivable. It's just being put up as security on a loan. In that case, you put down the amount of cash that you receive as a debit, of course. But what you're really doing is creating a notes payable that you owe this person $35,000, this bank or finance company or whatever. Now, what is missing here that's explained in this paragraph is that the amount of accounts receivable that they put up as security is actually $40,000. They didn't get $40,000 because they're taking into account that some of this may not end up being received. But they had to pledge $40,000 of their accounts receivable to get the $35,000. But this is the entry you would make when all you're doing is pledging as opposed to actually selling the receivables to a bank. I want to move down to this little section here, accounts receivable turnover, and a particular formula that we often use to try to judge how well a company is handling their accounts receivable. When you're looking at that, you're looking at both the quality of their accounts receivable and the liquidity. Quality means the likelihood that you're actually going to receive the money without loss, that you didn't loan to people who are going to end up skating on their loan. Liquidity has to do with the speed of collection. You know, you may get all your money up here, but are some people going to be slow to pay? And so an accounts receivable turnover ratio is a measure of both of those things. It indicates how often receivables are received and collected during a particular period. And the way that we go about doing that is we take our net sales for a particular period and divide it by the average accounts receivable. So you would take your net sales. This explains how we go about getting that particular figure. But this part down here is where you take your beginning accounts receivable plus your ending accounts receivable for that particular period that you're looking at and divide it by 2. So if we look at TechCom, their accounts receivable turnover is 5.1. So it indicates that its average accounts receivable balance is converted into cash 5.1 times during the period. In this case, the period is a year. So they're turning their accounts receivable over 5 times, a little over 5 times in a year. So this particular ratio allows management to determine how well they're doing in terms of granting credit to their customers, because the main reason why we do that is to try to increase sales. Not everybody can come up with the cash to buy the things that they need to resell, and so we extend credit to them. A high turnover in comparison with competitors suggests that management should consider using more liberal credit terms to increase sales, and a low turnover suggests that management might want to consider stricter credit terms and more aggressive collection efforts. So they give you an example of Dell and Apple here over 4 different years, 2008 to 2011. Accounts receivable turnover for Dell has been flat the last 2 years, 10.0, and it's been decreasing just a little bit since 2008 and 2009. And then with Apple, it decreased quite a bit between 2008 and 2009, stayed pretty flat here, but then increased quite a bit here. Now, increase, decrease doesn't necessarily mean anything. You pretty much have to compare it to other companies in their industry to see if this is typical. And this goes on to explain that they believe that both of these companies are doing quite well, and turnover for competitors in this particular industry is in the range of 7 to 12 for the same period. So they're, in the ballpark of what other competitors are doing. Often a number or a ratio all by itself means nothing to you. You have to compare it to other companies, but not just any other company, but companies in that particular industry, because turnover ratio for computers is going to be very different than turnover ratio for apples at a grocery store. So, but this particular ratio can be very useful to management in terms of looking at how they're handling their accounts receivable.